Jared Dillian. Own your money, own your life.
Hey, I'm Jared Dillian. Back to the Jared Dillian Show. Welcome back. We are talking about some cool stuff. We're going to be talking about, I don't know if you've ever heard of this acronym before. We're going to talk about ESG. Not ESP, ESG. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show, and we can make you some money. That is the goal. ESG. Let's say you want to invest, but you have a conscience, and you think there are good companies and bad companies, and you don't want to invest in the bad companies because you don't want to support bad companies. You don't want to support things that you disagree with. And you're kind of concerned about, if you invest in a mutual fund and the portfolio manager is picking stocks, you really have no control over what he's picking. And if he picks stuff that you disagree with, what do you do about that? So this is where we're going to start. And the bad stuff that people are usually concerned about is tobacco, alcohol, guns, and people are now upset about oil companies. They think oil companies are bad, which is, how do you get to work? Do you ride on a burro? No, you drive a car. But we want renewable energy and all this stuff, so people are upset about the oil companies. And the idea is that if you bought those stocks, if you bought tobacco stocks, alcohol stocks, et cetera, you would be supporting those companies. The evidence on this is mixed, to say the least. First of all, this is how this works. So when there's a stock that's trading on an exchange. So let's just say Altria, which is a tobacco stock. The ticker is MO, okay? And Mo is trading on an exchange. So if you buy 100 shares of Mo, you're not really helping Altria. It doesn't really do anything. First of all, you're so small, the price of the stock doesn't move. But let's say it did move. You moved it like a tenth of a penny. And what does that do? Well, I guess, if you're an executive of Altria and your compensation is based in stock, then I guess you're a teeny tiny bit richer. And I guess, the valuation of the stock affects the company's ability to sell more stock in a secondary offering or bonds. But once again, 100 shares doesn't really move the needle. So, look, Altria doesn't care that you're not buying their stock. And we'll get into more of that in a second. But, it would be one thing if you were participating in either an IPO or a secondary offering. This is how this works. I don't know if you know this. But when a company goes public, so a company is first, they're private. Just take, for example, Peloton. Peloton went public yesterday. One day they're private. There's no stock. The stock is private, basically. And the next day they're public, and they offer a certain chunk of the stock, and then people buy it. And what happens is when you buy that stock, the proceeds, the money actually goes to Peloton. Peloton sold 5% of the company. I don't know how much money they raised, maybe $100 million or something like that. So if you participated in an IPO, you are supporting the company. You are actually giving them cash. But if you buy the stock in the secondary market, it doesn't really do anything. So a lot of people are like, I have all these principles. I'm not buying these tobacco companies. Well, it doesn't really make any difference. If you participated in a secondary offering, then I would say, okay, then you're helping Altria. So let's think about this. Do you remember when Obama was president? It seems a really long time ago. That seems like a really, really long time ago. Back when Obama was president, when I had a lot less gray hair, people thought that he was going to confiscate guns. It was borderline conspiracy theory. Obama, he did try to pass a gun control bill. It wasn't even a very strong gun control bill. There was really no evidence that he was going to send, jackbooted thugs around to people's houses and grab their guns. There was just no evidence for that. But, as they like to say, Obama was the best gun salesman of all time because people had the fear that he would do that. So the whole time he was president, gun sales were going through the roof. And the gun stocks went way up. And when Trump got elected, the gun stocks crashed because people said, Trump's not going to take our guns, and literally the gun business went to zero. Now, the gun business has picked up again in the last 6 months or so because of these school shootings and stuff like that. But Trump actually was bad for the gun stock. So, what's funny is like everything in life is ass backwards. Like people just get it totally backwards. They thought Obama was bad for guns. He was good for guns. They thought Trump was good for guns. He was bad for guns. This is what I like to call Costanza, right? Where just stuff is just backwards. Okay. Yes. So if you say, now, as an individual investor, if you say, I am principled, I oppose selling firearms, I am not going to buy the gun stocks, okay, then what we would say about you is you have constraints, right? You won't just buy any stock. You are constrained. You will only buy certain stocks. Well, you will buy most stocks, but there's some that you won't buy. So you have constraints on your investing. And, for me, there's really no stock. The private prisons kind of bother me. But I'm not, even still, like I would still, I guess I would own a mutual fund if they own private prison stocks. I probably wouldn't buy it in my brokerage account, but there's really no stock that I wouldn't invest in. So I am an unconstrained investor. I can buy any stock I want. So here's how this works. You have constraints. There are some things you won't buy. I do not have constraints. How can anybody reasonably expect you to outperform me? How can we expect somebody who has constraints to outperform somebody who doesn't have constraints? Right? Because theoretically, it should be harder for the person who has constraints because he can't buy every stock. And it should be easier for the person who doesn't have constraints. And this, by the way, is, this is borne out in the markets. This is what happens. So if you look at the history of Vice stocks, the tobacco stocks from 1999 to 2019, they went up like thousands of percent. They were some of the best performing stocks in the world. And the gun stocks have done well. So all these bad stocks have done really, really well. So why is that? I mean, it's counterintuitive, right? Because you would think, you'd be, okay, nobody's buying these stocks. Now, theoretically, if somebody buys a stock, they push up the price. So if nobody is buying the stocks, then shouldn't the price go down? And that's actually not how it works. Basically, if I'm going to buy one of these stocks that nobody else wants, I have to accept more risk. And I have to be compensated for accepting more risk. And I'm compensated in the form of a lower price, and that stock will go up more over the time that I own the stock. So this is why, like for years and years and years and years, all these stocks that everybody said were bad companies have actually done way better. And people still, they can't figure it out. Now, this is what we're going to talk about this when we get back in a few seconds. But this idea where we're going to only buy the good stocks, there's a name for that. It's called ESG, and it stands for Environment, Social, and Governance. And we're buying stocks that are good for the environment, good for social justice, and good for governance. And what it means is we exclude lots and lots of stocks from that list. We'll talk about this in a few seconds. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.